After World War II, the United States government owed 106% of the entire economy in debt. That's like owing $30,000 when you only make $28,000 a year. By 1974, that debt had mysteriously shrunk to just 23%. The government told everyone it was because of economic growth and smart budgeting. That was a lie. Economists later discovered that 2/3 of that debt reduction came from a secret policy called financial repression. Here's how it worked. Keep interest rates artificially low, let inflation run hot, and watch as savers get negative real returns year after year after year. Your savings account earning 2%, while inflation runs at 4%, means you're losing 2% of your purchasing power annually. For decades. And here's what should terrify you. Every major economy is drowning in debt again. Interest rates have been suppressed for over a decade, and inflation is back. The same playbook that quietly stole wealth from an entire generation of savers after World War II is being deployed right now against your retirement savings. Subscribe because they're about to do it again, and this time you need to see it coming before your life savings disappear into thin air. The conventional narrative surrounding inflation portrays it as an unfortunate economic accident, a byproduct of misguided monetary policy or unforeseen market forces that central bankers struggle to control. This narrative serves a crucial purpose. It absolves governments and central banks of responsibility for what amounts to the largest wealth transfer mechanism in modern economic history. The reality is far more disturbing and deliberate. Inflation, particularly when combined with suppressed interest rates, represents a sophisticated financial weapon designed to quietly extract wealth from savers and transfer it directly to heavily indebted governments and their preferred constituencies. This mechanism operates through what economists term financial repression, a comprehensive suite of government policies engineered to suppress market interest rates below their natural equilibrium, while simultaneously channeling private savings into government debt instruments. Financial repression creates an environment where savers systematically receive negative real returns on their capital, while governments benefit from artificially cheap financing costs. The policy toolkit includes interest rate caps or pegs enforced by central banks, regulatory mandates forcing banks and insurance companies to hold predetermined percentages of government debt, capital controls preventing citizens from seeking higher returns abroad, and restrictions on alternative investment vehicles that might compete with government bonds for investor capital. The historical precedent for this systematic wealth extraction emerged most clearly in the aftermath of World War II, when major economies across the United States and Europe found themselves burdened with unprecedented debt levels. The United States entered the post-war period with public debt exceeding 100% of gross domestic product, while many European nations faced even more severe debt burdens following years of wartime spending and reconstruction needs. Traditional approaches to debt reduction through fiscal austerity or dramatic tax increases proved politically untenable, as war-weary populations demanded expanded social programs and economic recovery rather than sacrifice and belt-tightening. Faced with this dilemma, governments discovered financial repression offered an elegant solution that avoided the political costs of visible tax increases while achieving the same wealth transfer objectives through hidden mechanisms. By maintaining interest rates below inflation rates for extended periods, governments could systematically erode the real value of their outstanding debt obligations, while simultaneously extracting wealth from bondholders and savers who found themselves earning negative real returns year after year. This process functioned as an invisible tax that fell most heavily on conservative savers, retirees, and middle-class families who relied on safe government bonds and bank deposits for income and wealth preservation. The mechanics of this wealth transfer operated with mathematical precision. When governments borrowed money at artificially suppressed nominal interest rates of 2 or 3%, while allowing inflation to run at 4 or 5% annually, the real cost of servicing government debt became deeply negative. Bondholders who purchased government securities, expecting to preserve their purchasing power, instead watched their capital erode at predictable rates, effectively subsidizing government operations through involuntary wealth transfers that never appeared on any tax bill or government balance sheet. This system represents financial repression in its purest form. A deliberate policy framework that transforms savers from creditors into unwilling subsidizers of government debt reduction. Unlike traditional taxation, which operates through visible mechanisms subject to democratic oversight and political accountability, financial repression functions through complex monetary and regulatory channels that obscure its redistributive effects from public scrutiny. The result is a hidden tax on savers that operates continuously, year after year, transferring wealth from private citizens to government treasuries without the political friction associated with conventional tax increases or spending cuts. Financial repression operates through a carefully orchestrated system of regulatory constraints and monetary controls designed to trap domestic savings within government-controlled channels, while simultaneously suppressing the returns those savings can generate. The primary mechanism involves central bank manipulation of interest rates through direct pegs or caps that prevent market forces from establishing natural equilibrium rates. During the classical financial repression era, central banks would explicitly peg long-term government bond yields at artificially low levels, often 2 to 3 percentage points below what free market conditions would have produced. Complementing these interest rate controls, governments implemented comprehensive regulatory mandates requiring banks, insurance companies, pension funds, and other financial institutions to hold predetermined percentages of their assets in government securities. These captive investor requirements created guaranteed demand for government debt while eliminating the need for governments to compete for capital by offering attractive yields. Capital controls formed another crucial component, preventing domestic savers from seeking higher returns in foreign markets or alternative currencies that might offer better protection against inflation. Additional restrictions limited access to real assets like gold, real estate investment trusts, or foreign equity markets that historically provided inflation hedges for sophisticated investors. The adoption of financial repression emerged from a fundamental political calculation that governments faced in the aftermath of massive debt accumulation during wartime periods. Traditional debt reduction strategies presented insurmountable political obstacles that threatened the stability of democratic governments attempting to manage post-war transitions. Fiscal austerity requiring dramatic spending cuts would have eliminated popular social programs and economic stimulus measures that populations demanded after years of wartime sacrifice. Similarly, explicit tax increases sufficient to service massive debt burdens would have created political backlash capable of toppling governments and destabilizing fragile post-war economies. Financial repression offered an elegant alternative that achieved identical debt reduction objectives through hidden mechanisms that operated below the threshold of public awareness and political accountability. This stealth approach allowed governments to transfer wealth from savers to state treasuries without triggering the organized resistance that visible tax increases or spending cuts would have generated. The policy framework provided plausible deniability by operating through complex monetary and regulatory channels that obscured the deliberate nature of the wealth transfer while maintaining the appearance of normal market operations. The targeting of savers through financial repression operated with mathematical precision designed to maximize wealth extraction while minimizing political resistance. By maintaining nominal interest rates below inflation rates for extended periods, governments created an environment where traditional safe haven investments systematically destroyed purchasing power rather than preserving it. Savers who deposited money in Government-insured bank accounts or purchased government bonds, expecting to earn positive real returns, instead found themselves subsidizing government operations through negative real interest rates that could persist for decades. A saver earning 3% nominal interest while experiencing 5% inflation faced a real return of negative 2% annually, meaning their capital lost purchasing power at a predictable and continuous rate. This mechanism proved particularly effective because it targeted conservative, risk-averse investors who prioritized capital preservation over speculative gains and who lacked the financial sophistication or resources to access alternative investment vehicles that might provide inflation protection. Financial repression fundamentally transformed the relationship between savers and the state by converting what appeared to be voluntary lending into involuntary wealth transfer. Traditional savings instruments that historically served as shields against economic uncertainty became transmission mechanisms for systematic wealth extraction. The policy framework created a situation where the act of saving responsibly and conservatively resulted in guaranteed capital destruction, while governments benefited from artificially cheap financing that reduced debt service costs and enabled continued deficit spending without immediate fiscal consequences. The post-war debt crisis facing the United States in 1946 provided the perfect laboratory for testing financial repression as a systematic wealth extraction mechanism. American public debt had exploded to 106% of gross domestic product, a staggering burden that conventional economic wisdom suggested would require decades of fiscal austerity or punitive taxation to resolve. The scale of this debt load represented an existential threat to government solvency that demanded immediate action. Yet, traditional debt reduction approaches remained politically impossible given public expectations for post-war prosperity and expanded social programs. The solution emerged through a carefully coordinated campaign of financial repression that would span more than 3 decades and transfer trillions of dollars in purchasing power from American savers to the federal treasury. The Federal Reserve played the central role in this wealth extraction scheme by maintaining artificially suppressed yields on government securities through direct market intervention. Under intense pressure from the Treasury Department, the Fed committed to pegging long-term government bond yields at approximately 2.5%, regardless of market conditions or inflation expectations. This yield peg remained in effect until 1951. Creating a 7-year period during which government borrowing costs bore no relationship to economic fundamentals or inflation risks. Simultaneously, the removal of wartime price controls unleashed powerful inflationary forces that had been artificially suppressed during the war years. Between 1946 and 1951, consumer prices surged dramatically as pent-up demand collided with supply constraints and monetary expansion designed to accommodate government financing needs. The combination of artificially low nominal interest rates and rapidly rising prices created a devastating environment for bondholders and savers who found themselves earning deeply negative real returns on their government securities and bank deposits. Analysis of the complete period from 1945 through 1980 reveals that real returns on government debt remained negative more often than positive, with average real returns hovering around negative 0.3% annually. This seemingly modest figure masks the cumulative devastation inflicted on savers over multiple decades, as negative real returns compounded year after year to systematically destroy the purchasing power of conservative investments. Bondholders who believed they were making safe, patriotic investments in government securities instead found themselves unwilling participants in a massive wealth transfer scheme that subsidized government operations at their direct expense. The effectiveness of this financial repression campaign becomes clear when examining the dramatic reduction in debt-to-GDP ratios achieved between 1946 and 1974. Official government statistics show public debt falling from 106% of GDP to just 23%, a reduction that politicians and economists routinely attributed to robust economic growth and responsible fiscal management. However, sophisticated econometric analysis reveals the true source of this debt reduction through counterfactual modelling that isolates the contributions of different factors. When economists constructed models showing what would have happened if the United States had maintained neutral fiscal policy without the benefit of financial repression and surprise inflation, they discovered that debt to GDP ratios would have declined to only 74% rather than 23%. This analytical framework demonstrates that approximately 2/3 of the apparent debt reduction achieved during the post-war period resulted directly from financial repression rather than economic growth or fiscal discipline. The implications of this finding fundamentally challenge the conventional narrative surrounding American post-war prosperity and reveal the massive scale of wealth transfer that occurred through hidden monetary mechanisms. Rather than representing a triumph of sound economic management, the post-war debt reduction stands as perhaps the most successful example of systematic wealth extraction in modern economic history, transferring purchasing power equivalent to multiple years of national output from private savers to government coffers through carefully engineered negative real interest rates and inflationary policies designed to erode the real value of outstanding government obligations. The systematic implementation of financial repression created profound distributional consequences that fundamentally altered the economic landscape by punishing prudent savers while rewarding heavily leveraged debtors, with governments representing the primary beneficiary of this wealth transfer mechanism. Conservative savers who had followed traditional financial advice by accumulating government bonds and bank deposits found their carefully preserved capital systematically eroded through negative real interest rates that persisted for decades. Retirees and pensioners faced particularly devastating consequences as their fixed income investments provided income streams that lost purchasing power year after year, forcing them to either reduce their standard of living or deplete their principal to maintain basic consumption levels. Meanwhile, borrowers, including the federal government, benefited enormously from the same inflationary environment that devastated savers, as their debt obligations could be serviced with progressively cheaper dollars, while the real burden of repayment declined automatically through monetary debasement. The regulatory framework supporting financial repression created systematic distortions in credit allocation that undermined productive investment throughout the broader economy. Banks and financial institutions operating under mandatory reserve requirements and regulatory pressure to hold government securities found themselves channeling an artificially large portion of available capital toward government debt, rather than private borrowers seeking funds for business expansion, innovation, or productive investment projects. This crowding out effect meant that entrepreneurs, small businesses and growing companies faced artificially constrained access to credit, while governments enjoyed guaranteed financing at below market rates. The resulting misallocation of capital systematically favoured government consumption and transfer programs over private investment that would have generated productivity growth, technological advancement, and genuine wealth creation. Economic research demonstrates that countries implementing financial repression policies consistently experienced lower productivity growth rates compared to economies that allowed market forces to direct capital allocation, suggesting that the hidden costs of these policies extended far beyond the direct wealth transfers from savers to government treasuries. Financial repression created stark inequality between different segments of society, based primarily on their access to alternative investment vehicles and financial sophistication. Wealthy individuals and institutional investors possessed the resources and knowledge necessary to circumvent repressive policies through investments in real estate, foreign assets, commodity positions, or equity securities that provided better inflation protection than government-mandated savings instruments. These sophisticated investors could maintain or even enhance their purchasing power during inflationary periods, while ordinary savers trapped in regulated savings accounts and government bonds suffered systematic wealth destruction. The elderly and middle-class families who relied on conservative investment strategies bore disproportionate costs, as their retirement security depended precisely on the safe, fixed-income investments that financial repression targeted most aggressively. This dynamic created a perverse situation where risk-taking and financial sophistication were rewarded while prudent, conservative saving behavior was systematically punished, fundamentally undermining the traditional relationship between thrift and economic security. The apparent success of post-war debt reduction concealed a more troubling reality of systematic capital destruction that masked genuine economic damage beneath favorable government balance sheet statistics. While politicians celebrated declining debt-to-GDP ratios as evidence of successful economic management, the true cost appeared in the form of reduced private capital accumulation, diminished retirement security for millions of savers, and productivity growth below levels that would have emerged under market-determined interest rates. The wealth that disappeared through financial repression represented genuine resources that could have funded private investment, supported retiree consumption, or provided security for future generations. Instead, this capital was quietly transferred to government treasuries through hidden mechanisms that avoided the political accountability associated with explicit taxation. The debt reduction achieved through financial repression therefore represented not economic success, but rather a massive redistribution of wealth from private citizens to government balance sheets, accomplished through monetary manipulation that systematically destroyed the purchasing power of conservative investments while creating the illusion of responsible fiscal management. The contemporary economic landscape reveals an ominous return to the precise conditions that necessitated financial repression during the post-war era, with government debt levels across advanced economies reaching or exceeding the crisis thresholds that historically triggered systematic wealth extraction from savers. Following the 2008 global financial crisis and the unprecedented fiscal expansion during the 2020 pandemic response, public debt burdens have exploded to levels that render traditional debt reduction strategies politically and economically impossible. The United States federal debt now exceeds 130% of gross domestic product, while European nations, Japan, and other developed economies carry similarly unsustainable debt loads that dwarf their productive capacity and tax generation potential. This debt accumulation occurred during a period when demographic transitions toward aging populations have simultaneously increased entitlement obligations while reducing the working age tax base, creating a structural fiscal crisis that conventional policy tools cannot address without triggering economic collapse or social unrest. Central banks have responded to this debt crisis by implementing sophisticated variants of financial repression that achieve identical wealth transfer objectives through more subtle mechanisms than the explicit interest rate pegs employed during the post-war period. Quantitative easing programs represent the primary modern tool, allowing central banks to purchase government securities directly while maintaining the facade of market-determined interest rates. These massive asset purchase programs create artificial demand for government debt that suppresses yields far below levels that free market forces would establish, effectively replicating the yield suppression achieved through direct pegs during the classical financial repression era. Ultra-low interest rate policies maintained for over a decade have created an environment where savers earn virtually nothing on safe investments, while governments benefit from near-zero borrowing costs that eliminate the normal fiscal constraints associated with high debt levels. Regulatory frameworks continue to channel private savings toward government securities through capital requirements that force banks and insurance companies to hold predetermined percentages of government debt, creating captive investor demand that ensures ready markets for ever-expanding government borrowing needs. The persistent inflation that has emerged across developed economies cannot be dismissed as an accidental policy failure or temporary supply chain disruption, but rather represents a deliberate policy choice that serves crucial debt management objectives for heavily indebted governments. Modern central banks possess sophisticated tools and models that allow precise inflation targeting, making sustained above-target inflation a conscious decision rather than an unfortunate oversight. This inflation serves the identical function that overt financial repression achieved during the post-war period by systematically eroding the real value of government debt obligations, while simultaneously destroying the purchasing power of savings held in government-controlled investment vehicles. The combination of near-zero nominal interest rates and persistent inflation creates deeply negative real returns that transfer wealth from savers to government treasuries just as effectively as the explicit yield pegs employed 60 years ago. Contemporary savers face an even more challenging environment than their post-war predecessors, because alternative investment options have been systematically eliminated or regulated beyond the reach of ordinary investors. Modern financial repression operates through a comprehensive ecosystem of regulatory constraints that limit access to inflation hedges while funneling savings toward government-controlled instruments that guarantee negative real returns. The current system represents the maturation of financial repression into a permanent feature of modern monetary policy rather than a temporary emergency measure, creating an environment where systematic wealth extraction from savers has become the primary mechanism for managing unsustainable government debt burdens. Understanding this reality reveals that contemporary monetary policy serves not economic stability or growth objectives, but rather the systematic transfer of private wealth to government balance sheets through hidden mechanisms that operate below the threshold of public awareness, while maintaining the illusion of normal market operations.